Welcome back. Equity research analysts at Exotics Partners in their recent report on the Nigerian banks seem to be more positive on the sector. The research analysts have had a broadly neutral stance on the Nigerian banks in the past few months on the basis of the challenging operating environment and by implication deteriorating asset quality. But they say today the sector broadly offers significant upside to fair value. Let's bring in the author of this report titled Opportunity Beckons by Tier 1, Jumai Mohammed, Equity Analyst with Exotics Partners. Good afternoon, Jumai. Thank you very much for joining us.
Good afternoon, Timmy. Thanks for having me.
Right. You have had a broadly neutral view on the banking sector for some time now. You have now turned more positive in this note. What has changed?
Absolutely. This note charts a number of costs that we've seen recently that we believe to have a reinforcing impact on the banks. Particularly, some of the catalysts that we pointed to are the strengthening economy, particularly following the improvements in oil prices as well as oil production in Nigeria. You'll note that last year was quite severe in terms of militancy impacts. Also, we note the narrowing spread between the official and parallel market rates. Only 3 months ago, we had up to 60% spread between these two rates, but now this is falling down to about 24%. So we think a number of those developments should bode quite well for banks, particularly in terms of margins, especially those that we believe have the strength in their balance sheet and profitability to sort of take advantage of this, as well as liquidity to deploy to some of the securities that government is now pricing quite highly in the market. In the notes, we also note that for equity investors, particularly who have had challenges around FX convertibility, we're now beginning to see an improvement in terms of liquidity of FX. You're seeing with the investors and exporters window that has recently been provided, that we're beginning to see a lot more rally in the equity market on the back of that. We expect that this will continue, and banks in Nigeria currently will be amongst those that we will classify as the big sectors to be looking to buy at the time.
Now, as per the title of your note, you say opportunity beckons. Where do you see this opportunity? Is it sector-wide, or are there pockets of opportunities within the sector?
Absolutely. I mean, just to provide a bit more context, when we say that there are opportunities, it's because in light of historical valuations, Nigerian banks are now priced at 33% discount to what they used to be, even considering the financial crisis period, which we believe is quite extreme. And also, you can extend that analysis to other frontier peers, and you see that Nigerian banks are trading at as much as 64% discount to these peers, which we think at this point is unwarranted. The key things that a lot of investors had noted, and of course, as I had mentioned, is just inavailability of foreign exchange to come in and out freely in the Nigerian market. This depressed the market. We're now beginning to note some improvement on that level, but also because, again, banks have been exposed to legacy loans, as well as retail sectors, general commerce that has drawn them back significantly in the past, and we think that all of this, as the economy strengthens, will improve. Now, on your question as to whether the opportunity is sector-wide or we think it's in pockets, we think investors at this point should still remain quite selective. We think the preference should be for the banks that have very strong balance sheets, strong profitability, well above peers and above the cost of equity. Also, banks that, again, have an operational scale in which they can continue to maximize returns in this market. And for us, those banks particularly are the Tier 1 banks. That is GTB, Access, UBA, First Bank, Zenith, as well as Stanbic, which stands out amongst the Tier 2 banks. So because Stanbic has got a diversity introduced in its earnings in the form of its asset management business, which is quite resilient to recession.
So are these banks you've mentioned, are they your high conviction top picks in the sector?
Absolutely, but in order of preference, we think our top three will be GTB, Zenith Bank, and Stanbic for these reasons that I've mentioned, but also because we think that their margins and profitability will be well above peers, and they should compensate investors for the additional risk of be it further devaluation of the currency or further pressures on the FX market.
Now, what risks should investors be wary of?
By and large, today the biggest contingent risk in the sector remains asset quality. We haven't seen that change. In our view, asset quality problems still haven't peaked to date. We think that in 2017, NPLs as well as cost of risk of these banks will continue to worsen. And this is because of legacy loans that they've given out, for one. Also because of significant under-provisioning for some of the NPLs that they've recorded, and probably fresh slippages from certain corporate sectors. Not to go into too much details, we've had recently a few companies come under pressure in the media as to the quality or their ability to meet out with the bank loans. So we think this will remain an issue in the year. However, as I mentioned, some of the banks that I alluded to already, we believe are strong enough to maintain their capital and profitability in spite of that, in spite of this growing cost of risk and NPLs. So we would prefer those banks in this environment. Conversely, we think that for tier 2s, there's potentially a lot more pressure there, given that they have a lower profit base at the time, and it could potentially lead to further capital requirements in the future.
All right. Thank you very much for your time, Jumai Mohammed, equity analyst with Exotics Partners. Enjoy the rest of the weekend. We move on now. Royal Dutch Shell is seeking to sell its gas fields in Tunisia for some $500 million as the Anglo-Dutch company pushes forward with its vast disposal program. The Tunisian assets, accounting for some 65% of the North African country's gas production, were acquired as part of Shell's $54 billion takeover of BG Group last year. The assets include 2 offshore gas fields, Meska, fully owned by Shell, and Hartsdrubal, 50% owned by Shell. And finally, Angola's state oil company Sonangol has cancelled an auction of oil exploration license for 8 blocks, blaming the drop in oil prices since the bidding opened. The round includes 5 blocks in the Kwanza Basin and 3 on the Lower Congo. And that's it on the program for today and, of course, for the week. Thank you very much for watching. I'm Chimezie Obi Iwawu.